Before I start my first episode of Energy View by Petrochemical Strategies, I want to thank everybody who contributed to reformatting this blog. I appreciate your insights and thank you. When I started writing this blog, news was coming out of Europe that Brent crude futures were closing down $1.33 per barrel to $101.44 per barrel. This came on the heels of West Texas Intermediate crude futures closing below $100 per barrel for the first time since April of this year. This chart shows data from the U.S. Energy Information Administration showing the Cushing, Oklahoma crude oil price futures from July 2021 through the end of June this year. The orange and gray lines on this chart are the New York Harbor prices for RBOB and number 2 fuel oil, more commonly known as diesel, respectively over this same period of time. What I found interesting was the 3-2-1 crack spread during this period. As you can see from this chart, which I prepared using the EIA data, the 3-2-1 crack spread hovered around $20 per barrel until about March, when it accelerated upwards. The 3-2-1 crack spread is an indicator of refinery margins, which confirms what we already suspected. Refineries are making a lot of money in this current environment. There are two things I'm watching very closely to see if there's some relief on the way. The first is retail gasoline, which averaged $4.77 per gallon on July 4th and was down over 10 cents per gallon from the previous week. This is a strong indicator because this happened during a very busy driving weekend. The second are the forward curves for both Brent and WTI crudes. A quick glance at the Intercontinental Exchange and NYMEX showed that both Brent and WTI futures have a strong backwardation, meaning near-term prices for oil are more expensive than those barrels delivered in the future. This could be a leading indicator for a global recession, or this could be short-lived as global supply tightness could hold up the front-month prices. Let's keep an eye on this. Now let's turn our attention to natural gas. What you see here are the futures contract prices for U.S. natural gas in dollars per MMBTU as published by the EIA. You can see a very similar pattern to what we saw in the 3-2-1 crack spread as I showed earlier, as natural gas prices remained in that $4 to $6 per MMBTU range until March, then accelerated upwards. Prices have been coming off since the middle of June. There are a lot of unknowns in the global natural gas market. First and most important is the invasion of Ukraine by Russia and what this may have to do with European industries as we near the winter. Second, if natural gas prices continue to stay relatively high, what will be the impact on alternatives like coal and oil? And lastly, will high prices and global logistics challenges accelerate the transition to renewables and clean energy? As a result of these unknowns, the International Energy Agency is forecasting slower growth in the coming years for global natural gas. Let's turn our attention to petrochemical feedstocks, or NGLs. According to the Natural Gas Weekly Update published by the EIA, U.S. natural gas liquids prices were relatively flat towards the end of June. They reported that prices for ethane and natural gasoline moved up only 2%, normal butane and propane were flat, and the only price outlier was isobutane, which rose 7% for the week ending June 29th. In inventories, the EIA reported that ethane and ethylene inventories were down almost 10 million barrels in the first quarter of 2022. They also reported a similar change in butane and butylene's inventories and a much more significant change in propane and propylene inventories. Over the coming months, I will be introducing a petrochemical model which will use to make sense of the petrochemicals market. Until then, I can confirm that margins are strong in the industry and producers are likely running full out. Thank you for watching Energy Views presented by Petrochemical Strategies. My name is Robert Sawchik and I will see you next time.